Okay, good afternoon, everybody. It looks like it is right at 1 o'clock Central on the dot, so we will go ahead and get started. Welcome, everybody, to our December 2022 Provider Audit webinar. So as some of you know, those of you that have attended our webinars in the past, we try to have 3 to 4 of these a year, including one of them that's devoted currently to the S10 audits. And that's always at the beginning of the year, the beginning of that cycle. Although the other webinars, we tend to still talk about S10 and some of the updates. But with this webinar, we're going to be covering a variety of topics, as you can see on the slideshow right now. And again, I sent out the agenda and the slides to everybody. Hopefully everybody was able to receive that earlier today. Some of you, the first email that went out didn't have the attachments, so I quickly resent another one. But again, our agenda is covering a variety of audit topics, and our goal is to first of all, give you a chance to ask questions if you have any as we go through the topics, but also to give us a chance to communicate certain things that are either changes that are coming up or just hot issues that we needed to mention. So we try to have 3 or 4 of these a year, and this is our last one for 2022. So for the agenda, again, we're covering a little bit of S10 uncompensated care audits. We're just in the process of really wrapping up this year's cycle, but there are a few changes coming up in the later year based on the 2023 final rule. We're going to talk a little bit about some changes to the changes that are related to desk reviews and audits that CMS makes changes for us, and it may result in changes to documentation requests, for example. So we'll talk a little bit about that. We're going to talk about, just in general, some of the cost report documentation requirements from the Paperwork Reduction Act. These are the various templates. So these topics are somewhat related, but they're still distinct. We'll give another overview of current DISH issues. This one's a carryover from last time as well. We have a new topic with graduate medical education and a certain decision, the Hershey decision, that was just recently issued and recently implemented, I should say. We'll talk about home office costs, and then a topic we always try to bring up, just giving you an update on various website articles, webinars, YouTube channel videos that we have out there. And of course, we have time for questions. Keep in mind, though, if you have questions on a particular topic, you can certainly ask that while we're on that topic. You can type it into the chat area. I've got that open up in another monitor, so I can pause from time to time to ask questions. Just a quick note also that the webinar is recorded as it has been in the past, and we will load that to YouTube, our YouTube channel, very shortly, probably within a week after the session, and I'll send out an information email at that point as well. So I have one quick topic that is not even on the agenda. It wasn't submitted before, but it's pretty important for certain providers. I just wanted to throw this out here for a few minutes. This is related to low volume hospitals and Medicare dependent hospitals. So these are all acute care hospitals. Those of you that qualify for this are well aware probably of the fact that the status originally expired on 9/30 of 2022, and then there was a late change by Congress, retroactive change to extend it, but it was a very, very temporary extension, just a stopgap. So that extension expires again in just a couple days on December 16th. Now, again, this is absent further congressional legislation extending it. I imagine they're going to extend it, but it's just a question of when. So the thing about that, even if they were to extend it today, even if they were to somehow quickly pass legislation and get it signed today, which is pretty much impossible, but even if they were, CMS still has to implement that. They have to go through their process to send us the instructions to act on it. Again, I mean, it'd be a miracle for this to happen and be implemented by 12/16. So what this basically means is that those low volume and Medicare dependent hospital payments will be shut down again on 12/16. And then again, assuming the Congress passes this and CMS eventually implements it, we will have another retroactive type situation down the road. So it's unfortunate. It certainly is extra effort on our part as well to go through the work of changing the FIS system, changing our claims processing system to terminate the payments, and then reestablishing the payments retroactively and reprocessing claims. It's unfortunate. It'd be nice if these were able to be done ahead of time, but that's unfortunately kind of the environment we're in right now with this. So just a heads up for those providers that they will be stopped 12/16, and more to come on that once Congress passes that, assuming they pass it. So now just a quick update on the S10 uncompensated care audits. So we are currently, we're in the 5th year of S10 audits overall, but we're in the 3rd year of auditing 100% of DISH eligible hospitals. The first 2 years were just samples of providers, basically. So, of course, the first few years aren't really as relevant right now, but we have the 2021. And by the way, when I'm talking after that, we audited 2018 data for 100% of the DISH eligible providers, and that was used for basically the claims 10/1/21 through 9/30/22. That was used to pay those claims. The claims we're currently on 10/1/22 through 9/30/23 this is based on the data from 2019 that was audited. Oh, I should take that back. It's 2018 and 2019 averaged together. That was a change that was made in the 2023 final rule back in August of this year, a few months ago. So the proposal that was finalized was that they're going to start averaging data, and they started with 2018 and 19 data, so just 2 years right now. But next year they proposed to go to a 3-year averaging. So assuming they finalize what they proposed this year, assuming they finalize it next year in August of next year, then we expect to see 18, 19, and 20 averaged together to set the rates for the federal fiscal year 2024, basically effective 10/1/23. Again, that's all speculation until they actually finalize it, but that is the path they're trying to go down at this point. So we're currently auditing those federal fiscal year 2020 cost reports, and we have to, in fact, the adjustments have all gone out or will be in the next day or two, because we have to get these wrapped up by the end of the year. So that's kind of where we are for the DISH uncompensated care at this point. And just quickly, I see a question here. Back to the low volume. Will providers who already qualify have to reapply if low volume is extended? My hope is not. I think the last time they had this kind of 2 retroactive situations in a row, or the mid-year, the split year, they basically took the initial attestation, and that was good for the entire year. So I certainly hope that's the case. But again, until we get the change request, it's speculation. So yeah, my hope is that they won't have you go through it again. Because what could change mileage-wise, for example, in 2 months? Very unlikely for any changes. So hopefully they'll agree with us on that. Good question, though. And again, as soon as we hear information on that, we'll be sending it out through a e-news article, updating the website, and letting providers know. So we are, again, currently auditing the 2020 data. Now, what we're auditing, again, it's 100% of the hospitals, but by that, we're talking DISH eligible hospitals. So, of course, it's only acute care hospitals, but also only those that report DISH on E-Part A. Now, this also includes sole community and Medicare dependent hospitals, although there's a pretty good argument to be made that even though they report DISH, they may not really see a difference in reimbursement depending on how DISH changes, because if their hospital specific payment is way higher than the federal payments, then it really is irrelevant. Regardless, in last year's final rule, CMS addressed that, and they made it pretty clear that we are still reviewing. We still have to review for the sole community hospitals and the Medicare dependent hospitals. so that unless that changes down the road, we still have to include those. This year, we tried a slightly different approach. Instead of waiting a little bit later, like in March or so, we sent out the letters in phases because some of the earlier fiscal year ends between the 10/1/19 and 9/30/20, some of those had already been submitted. They already had we already had them in house. We're already ready to go with those. So we sent the letters out for the first half of that fiscal year group, and then later on, a month or so later, we sent out the rest of them because, especially with cost report extensions that were in place this year, for those later fiscal years, we just didn't even have the cost report yet. We didn't know whether they qualified for DISH for sure. So we're probably going to follow that same approach in future years. And again, our due date at this point is always 12/31 of the year. The one new thing I wanted to add here is that these S10 audits apply to any provider that reports DISH on ePart A. So you could have a situation where the as submitted cost report did not show ePart A, and then something happened, maybe an SSI ratio was updated, maybe there was new data for the Medicaid ratio, and then maybe the provider was able to submit an amended cost report that brought them into DISH eligibility. CMS has made it very clear we have to keep track of that, and we do have to do an S10 audit, even if the as submitted, or even if it wasn't DISH eligible when we first started the S10 audits earlier in the year. Now, this can obviously be troublesome because they're supposed to be done by 12/31. So let's just say we get an amended cost report in by like December 1st, or today for that matter. CMS still expects us to get that done. Now, obviously, if it's today we received an amended cost report, we would have to work with them to get at least a month. But after 12/31, they're very tight on what they can accept because they need this data ready to go so they can work on the next year's proposed rule. So they'll give us a little bit of time, but not very darn much. So the biggest thing to note here is that if you do have something that's changed and you're now going to qualify for DISH, submit it as soon as possible so we can work. It gives us time. It gives you time to work on that S10 audit as opposed to being tight toward the end there. So that's what we have for that. A little bit of information on some of the S10 lines. Again, a lot of this we've talked about many, many times through various webinars. It's always good to have a little refresher, and we have a little bit to add to some of these things. So just as a reminder, and I have a screenshot and just a few slides that gives us the S10 work paper we can refer to in a bit. But we have S10 line 20. Now this represents the charity care. It's either charges or deductibles and coinsurance, depending on whether it's insured or uninsured. But it's charity care for the entire facility at this point. There have been discussions in the Federal Register about possibly changing this to just the hospital and not the entire campus. But for right now, we're still reviewing the entire facility. So line 20 is charity care, and it's at the full amount. It's not the cost itself yet. That will be diluted down to cost or reduced down to cost by the time we get to line 23 with the cost to charge ratio. Line 22 is kind of a tricky line, especially for those of you that were working on S10 pre-2016 when the instructions were different. Line 22 is basically, it's a payment or a partial payment made by a patient that was approved for charity care, but they still decided to make a payment against that charity care amount, and the hospital accepted it. We've heard from quite a few hospitals that if that situation existed, where the patient made a payment that they really didn't need to, that the payment would be returned. And in that case, there's nothing to report on line 22. So in that situation, again, basically CMS expects line 22 to be a small amount, if any. So, but if it is there, we will be revising that, or we be reviewing that. Line 25 is another odd cell. And this is one of those that's going to be changing. We expect it to be changing. We've proposed that it change in one of the upcoming cost report sets. But line 25 reflects situations where you had a charge on line 20, column 2, which is your insured, but which again sounds weird, a charge in the insured column. Normally that insured column 2 is supposed to be just deductibles and coinsurance. But if you had a situation where you had patient days that were beyond a Medicaid or indigent care program's length of stay, then it's a charge amount. There's no coinsurance deductible. It's not covered. So the current cost reporting instructions say, okay, go ahead and put that charge in the insured column 2 of line 20. But since it's a charge, we somehow have to tell the system to reduce it by the cost to charge ratio. So putting that charge also in line 25, in other words, it's in both places. It's part of line 20, column 2, and just the charge related to these specific days is also in line 25. That just tells the system how much of the line 20 amount to reduce by the cost charge ratio. So it's a really clunky mechanism, and it's not consistent either, because there are other non-coverage situations where the chart, again, maybe they've exhausted benefits for some other reason, maybe a certain service wasn't covered, but it's not this whole length of stay issue. Those other non-covered situations, they're just going to end up in line 20, column 1 for the uninsured, and they're automatically going to be subject to the cost charge ratio. For whatever reason, CMS wanted these particular situations, these Medicaid length of stay issues, to be set aside separately in a different mechanism. We've proposed that CMS just eliminate this line 25 and instead treat it like any other non-covered charge. Just put that portion in line 20, column 1. If there was a covered portion of that claim, that the coinsurance deductibles would belong in line 20, column 2, but the non-covered portion would go in column 1. So again, I don't want to spend too much time on that, but we propose that. We'll see what happens. Line 26 is labeled total bad debt expense, and I have that in quotes for a reason. The word expense is kind of wrong. It's flat out wrong for a couple reasons now, but the initial reason was that we never wanted an expense amount here anyways. We want a write-off amount instead. And under GAAP, the expense, when it was an expense up till the past couple of years, when it was an expense, the expense entry would have taken place first, and then the write-off, the expense was an estimate. The write-off would have taken place, who knows, 6 months, a year, 2 years down the road when that patient was actually written off. Again, we want the write-offs, but furthermore, this write-off that we're talking about is not necessarily the Medicare write-off if that was a Medicare patient to begin with. It's the accounts receivable write-off. So regardless of whether or not it met all the requirements for Medicare bad debt write-off, we want it when it's written off the accounts receivable. So again, 2 reasons there. The first reason is that it's not really an expense. The second reason, we don't really have bad debts as a later topic in this session, but some of you, hopefully you're aware of the change that was recently made by GAAP, started a few years back and it was extended a little bit, but it now has changed the bad debt treatment. It's no longer considered an expense, a separately reported expense on the income statement. Instead, it's now a contra revenue account. It directly offsets revenue through what's known as an implicit price concession, that we will talk about that in just a bit. So again, it's not even at all related to expense anymore, but we're looking for total bad debt write-off for line 26. So the information we're going to be requesting when we start these audits, and again, you've already gone through that this year, we look for the financial assistance policy or the charity care policy, whatever name you give it, or you might have both. And the big thing here, charity care versus indigent bad debts, for example, is that we're concerned, and CMS is concerned with what's in your policy and are you following it? So what's clearly written in your policy, and does your practice follow that policy? The indigent bad debts for Medicare, there's that very stringent requirement that we look at. It used to be assets, liabilities, revenues, and expenses. Now it's just assets and income after 10-120. But again, that's indigent Medicare bad debts. Charity care does not have to follow that stringent rule. It just has to follow your own policy, which could obviously differ from provider to provider. So it has to be in your policy and you have to follow it. But there are still a few rules that apply. For example, courtesy discounts for certain patient types that it's not related to their financial status. So the most common one is a clergy type discount. You might have an employee type discount. Those are courtesy discounts, and they're not allowable as charity care, no matter what your policy says. Also, professional fees, physician and professional fees are not allowed. So those are the main requirements, but the rest is all on your policy. And Shannon, that's a good question. So what do I mean by entire facility versus just the hospital? So we're talking about all the subunits, the HHAs, things like that. That would be in the entire facility. But the rule change CMS proposed and then they backed down from was that they want to eventually get to just the main hospital itself instead of any of the subunits. And the argument is good. There's a good reason for it. DISH itself related to just the hospital and not any of the subunits. So it makes sense that the charity care that replaced DISH or part of DISH would only relate to the hospital. But again, they have not finalized that proposal yet. They backed down this year. They'll reconsider it for future years. So we have the financial assistance policy. Again, some specific things you need to identify are whether or not this includes both insured and uninsured patients, whether it includes any of these non-covered services for Medicaid eligible or indigent patients, and how you handle coverage from an entity without a hospital contractual relationship, how you treat it if you allow that. So back in, might have been, it was early to mid 2020, we sent out a letter reminding providers that they had to have that charity care policy updated. CMS was really making sure we were reviewing it and that we would only allow things that were in the policy, clearly in the policy. So there's a little bit of a grace period though there if something was unclear. If it didn't specifically say no, it's not allowable, but it obviously didn't say it was allowable, then we allowed for a little bit of grace there for you to get the policy updated. But if it was very specifically not allowed, of course, there's nothing we can do. We cannot contradict your policy. So just some things there. I think we've talked about column 1 and column 2 enough. Column 1 is uninsured, including any non-covered type thing. Column 2 is insured. And let's see. So I already talked about it can't have physician or professional services. Obviously, if it's a bad debt, whether it's Medicare or non-Medicare, that goes in line 26. It cannot also be in line 20, which we'll actually touch on that in just a bit in a couple slides. I talked about courtesy discounts versus self-pay discounts. Those are two completely different things. Self-pay discounts, usually for uninsured patients just by definition, if those are in your policy and you're allowing it, you're following that policy, we don't have any problem with those being considered charity care. They're based on the fact that you're uninsured and maybe you have some sort of thresholds against the federal poverty level, whatever works for your policy, but you have to be following it. That's the key thing. One other thing I want to mention for charity care, presumptive eligibility is allowable. In other words, if you're using some third party, whether it be just any third party, if you're using them to determine whether or not a patient qualifies for this coverage, that's allowable for charity care. For Medicare indigent bad debts, however, it would not be allowable. So a few things there. Line 22, we already talked about the payments, and line 25 is that odd Medicaid length of stay limit situation. Line 26, again, bad debts follows the same rules as charity care. You cannot have physician or professional services, and you cannot have any insurance company bad debt, although that's obviously very rare. You can't report a bad debt related to someone other than the patient. If there's some other party that's liable for it other than the patient, that can't be a bad debt. The key thing for the timing is that it's not the date of service that determines when it gets reported on the cost report. It's the actual write-off date. So part of our audit will be verifying whether through sample or if something just looks unusual, we have to verify that write-off date against what's in your general ledger, whether it be charity care or bad debt. We have to follow that. And I see a couple questions. Let me get through this next two slides, and then I'm going to address these questions because a couple of them at least relate to this. So this is something that's relatively new that's come up recently, and we wanted to really stress it. It's not a new requirement, but it's something we've been seeing in some of the audits. And it's important to understand that bad debts and charity care are not interchangeable. They're completely separate things. So part of our review is looking at the transaction code listing that you send. And in addition to the codes, there should be like a legend. What does this code mean? Is this a type of bad debt? Maybe you have 3, 4, 5 type of bad debt accounts, or is this one of your many charity care accounts? We need to know what those codes mean, and whatever it's written off to, we have a couple things. First of all, we need to see, was that the right thing? Was it really a bad debt? And if it really was a bad debt and it was written off as a bad debt and it's reported in line 26, then we're fine. But if any of those things don't happen, if it's really, for example, if it's really charity care and it was written off as bad debt, that's where the problem comes in, because at that point it's basically a tainted account. It wasn't written off to the proper thing. Even though in the end, bad debts in charity care, at least bad debts in uninsured charity care, they end up having the same effect to line 30. CMS has really stressed the importance of getting them in the right place for whatever purpose, whether they're using this data for other things. I really can't speculate on that, but they're really stressing that we report that we get the right things in the right amount, or in the right account, if you will, right line. So this takes us to the next slide that really addresses the difference or distinction between bad debts and charity care. And I'm going to start with bad debts because of some of the new terminology we have that I talked about. The idea behind a bad debt is that the hospital still has legal entitlement to that, to collect it, and technically they keep legal entitlement to it even after they've written it off. I mean, technically years down the road, you still have a legal claim to collect that bad debt. It's just that as time passes, the likelihood that you'll collect it obviously gets smaller and smaller. So you still have legal entitlement to collect that amount, that remaining amount, but you realize you likely won't be successful, and that's why you've written it off. As I said earlier, it used to be a bad debt expense. I'm not saying what we wanted to report on line 26 was expense. I'm just saying from an accounting perspective, it was an expense. And as I said earlier, under GAAP, this is now a contra revenue, in other words, a revenue offset. And the term that's used is implicit price concession. And I want to stress that word implicit. What this basically means is, yes, you priced a service at a certain amount. Yes, you expected to collect the whole amount, or maybe I shouldn't say expected. You're entitled to the entire amount, but you realize just due to the nature of the business that you're not going to collect all of it. So you understand that the revenue you actually are going to be able to collect is less than that. So it's implicit because it's not something you explicitly tell the patient, oh, hey, you don't have to worry about paying this. Instead, it's just something that happens as a residual amount. You just don't collect it because, for whatever reason, the patient didn't pay, uh, they couldn't pay, whatever. But the key word is an implicit price concession. The key thing with bad debt is you still had legal claim to that amount. With charity care, you're waiving legal claim to that, no different than what you're doing with the contractual allowance. As part of your charity care policy, which is generally public to patients on their website, on your website or whatever, you're basically saying, hey, if you meet these requirements, if you're whatever, 100% of the federal poverty level, below that, maybe slightly above it, or whatever your criteria is, you're telling the patient, if you can document all this and you meet this, hey, don't worry about paying this amount. You're no longer legally liable for that amount. So the difference here is that this is an explicit price concession. You're explicitly reducing that amount, no different than any other discount or allowance. So it's not the same as the bad debt. You no longer have legal claim to that amount. You've waived it. Yes, it's still a contra revenue. And in fact, it's always been a contra revenue. It's always reduced revenue. It's never been an expense per se. But the fact that they're both now contra revenue accounts doesn't mean they're the same thing. They're interchangeable. They're two distinct contra revenue accounts. So that's the point I wanted to stress here. So now let's see, on to these questions. So we see, what about deceased or bankruptcy accounts that are defined as charity accounts per the provider's policy? So if you went through your true policy and you determined that they were charity care, they met whatever requirements you had, then they would be charity. The only way they're bad debt basically is if you didn't, if you lost, if they're bad debt if you still had legal claim for them, so you didn't have anything in your policy that would essentially tell the patient, hey, don't worry about paying. Remember, a write-off, when you write something off for bad debt, you're not really saying to the patient, don't worry about paying it. You're just internally saying, hey, we're probably not going to collect it. But you'd probably be very glad if that patient came back and paid that bad debt write-off. I would hope you would. But again, if it was a charity care and the patient came back and paid it, a lot of hospitals we've talked about have a strict policy saying, hey, we return that amount. They're not legally liable for that amount anymore. So that's the difference there. Sally, that's a good question. Is bad debt ever explicit? I would say not, because you're not, again, you're not telling the patient don't worry about paying it, because if you did, that's more of a charity care write-off. So I guess that would be my answer for that one. Looks like I skipped a couple as well. So rural health clinic, bad debt charity, provider-based clinic, bad debt charity. You're correct. Yes, all of those except for the professional component for the bad debt amounts and the charity. And is QMB presumptive? So the QMB, let me think about that, because that's the Medicaid. They're Medicaid and Medicare eligible. So I know from the Medicare bad debt side of that, we still call that. I mean, basically that's the indigent or the dual eligible bad debt, if you will. So I would say, yeah, I guess I would say that's presumptive, because you're relying on some other rule. In that case, it's not really another party, it's a requirement that they not be billed for those certain amounts. So yeah, I would say that's presumptive at that point. And let's see, if we have a discount fee schedule for uninsured patients and net the accounts to that fee schedule, but the patient ends up not paying the discounted amount, can we still report the full charge as bad debt instead of just the discounted fee schedule amount? So it sounds like you had an uninsured patient, you gave them the discount, so it sounds like maybe a self-pay type of thing. You've already reduced some of it, and then they didn't pay the amount they were supposed to pay. in that situation, I would say it's going to be half and or part both, part charity, part bad debt. Whatever was in your policy for that discounted amount is basically your self-pay discount. That should be charity, and then the portion that they were still required to pay but they didn't pay, that would be the bad debt. So yeah, and your note is right on. The bad debt transaction code would only show the amount, the discounted amount that they were supposed to pay but didn't. So in that situation, part of it's going to go to charity, part of it's going to go to bad debt. And if the hospital is not legally able to keep the payment on charity write-offs, why is that even listed on S10? So that's a good question, and I don't know if it's a rule. We've heard from a lot of providers that they have policies returning the payment, but not 100% of providers. Now, I'm not sure where the law or where the rule comes from that you're referring to. If there truly is a national type rule, a federal type rule, then you're right. That would make sense that line 22 should never exist. But I don't believe it's a federal rule. And if it is, it certainly isn't being followed by everybody, because we do see providers that have valid line 22 amounts, although they're relatively small. So I guess that's the answer I have there. It'd be nice if there was a consistent rule across the board to return the patient payment, but I just don't think there is. So good questions there. Okay, we'll move on to the next topics. Here we have the worksheet S-10 screenshot, just kind of showing the amounts here. So we have line 20. You can see here the two columns. Line 22 is your payments, also two columns. 26 for the bad debts, and I think so the initial information requests here. We talked about the charity care policy, the query logic, the description of the method you use to query your records, how do you get the amounts to report on each line, the listings, any explanation of significant variances, and then a reconciliation from the amounts on the cost report to your working trial balance or financial statements. In some cases, we'll have follow-up requests. If we have to do a sample selection, we'll look for the detailed documentation behind that. Obviously, bad debt line 26 and possibly a sample there. Query logic questionnaire. So this phrase query logic, is basically CMS's way of saying, hey, get information on how did the provider go through their systems and make sure they were grabbing the right things, the right elements for each line. So we have a questionnaire that's been built over the years. It's been expanded over the years to try to first walk providers through what those requirements are, and then also give us a narrative so that when we're auditing this, we can show that, hey, here's the control the provider has in place to ensure they've excluded fee schedule, for example, or just whatever you're trying to exclude. So that's essentially what the questionnaire is about. It's a training tool, and it's documentation, or at least the start of documentation for our audit. But the idea of what CMS is really stressing with these S10 audits is that we'd prefer fixing all of the errors, all the obvious errors, the pervasive errors up front, so we have a clean listing before we move into the statistical sampling and extrapolation, because then we can identify any pervasive errors up front, and the only things we'll be extrapolating are those errors that we really couldn't have possibly found without doing detailed testing anyways. So that's what CMS stresses that we do in that way. So that's where a lot of our time is just spent up front reviewing that query logic questionnaire. And what I'll mention here in the upcoming years, the CMS really is stressing this even more and more, and stressing detailed testing less. Most of these errors should be a little more obvious, a little more things we can eliminate up front. That's their belief. And that's kind of what we've found as well. And let's see, we had one more question here on S10. Can we have a Medicare insured patient account claimed on S10 as charity? You're exactly right. You could, as long as it's not also included as Medicare bad debt. Now, the thing is, it's a little bit of a risk when that happens because we would likely ask a question. Hey, this is a Medicare patient. What was the reason? Why was this not written off as Medicare bad debt? Because generally speaking, you'd probably get more money by writing it off as Medicare bad debt. Of course, a valid response might be, hey, you just didn't meet all the Medicare bad debt requirements, so you wrote it off as charity. It was an indigent patient because indigent Medicare patients, the indigence policy is often similar to the charity care policy, or maybe one and the same. So that would be where the situation comes in. But if it was not a Medicare indigent patient, then again, the question would be, what did you truly write it off to in your transaction code? But if you use charity transaction code and you could kind of explain why you didn't write it off as Medicare bad debt, maybe you didn't meet the must bill policy, for example, then it certainly would be allowable in line 20. So it's a little red flag, but it doesn't mean it's not allowable. So good question there. So now what we have is just a list of some of the training we have, the various websites. Again, everybody has the slides, so you can talk about that, or you can look at that if you need it. So now I wanted to move on to the topics related to cost report documentation. And actually, this slide I think is a little bit out of order. I'll briefly introduce this, but the next slide kind of jumps to a slightly different topic. These documentation requirements that changed a couple of years ago, they established not so much the template. They gave us a draft of the template that we have on our website, but they basically said for GME and IME, for Medicare bad debts, DISH Medicaid eligible days, and the various S10 items, you must have some sort of listing to support the amount on the cost report. And for home office costs, they said that if you're reporting home office, you must make sure that the home office cost statement was filed with the home office servicing MAC, not with every single individual MAC, but just the home office MAC that you normally work with. And the requirement was that the amounts must correspond to the data from the cost report, which doesn't mean they have to match perfectly, but they have to be pretty darn close. Again, could be a rounding issue, could be a roll-up error, things like that. But we'll come back to that topic with the templates in just a bit. This is the new topic I wanted to bring up today. We're actually going to be putting together a YouTube video going into a little bit more depth with this, but this is a perfect time to bring it up. So, when we're doing our desk reviews or audits, which every single cost report goes through either a desk review or an audit, depending on the scope, the dollar amount, the materiality. So when we review these, we are required to use desk review and audit protocols that CMS gives us. And they change it from time to time. Sometimes they'll issue a new desk review. Sometimes they'll update the audit programs. And sometimes they'll just on the fly, they'll say based on findings they've noticed nationally, they'll have a stress or focus our review on certain topics. So they can either be permanent changes like a desk review change or just hot issues that are coming up that they really want us to look at. And as I said earlier, this impacts the documentation requests that the auditors would have to send to the providers. What are we looking for? What do we need to see? In some cases, thresholds might change that determine our scope for a certain review. Now, of course, we can't release thresholds. We can't tell anybody outside of the MAC what the thresholds are. But again, if they change, what that might mean is that, hey, this particular topic was not reviewed in the past, and maybe this year is about the same amount, but now all of a sudden we need to review it. That situation could happen. And it just depends on the scope. How was that issue scoped? Either due to the dollar amount or CMS requirements. But one point I wanted to stress here is that and I don't want to, maybe failure is the wrong word. The fact that we didn't review or adjust an item in the prior year should not be considered passive acceptance that you must have been doing everything right. Not everything is reviewed on the cost report. And in fact, most cost reports, there are fair items, fair amounts that are not reviewed just due to scope. And if we scope it a different way the next year, because CMS requires us to, perhaps, we might be making adjustments that you didn't see in the past. So it's just that we're now supposed to look at a topic. That's kind of what comes up. Again, we can't send the desk review protocols or the thresholds. But what I wanted to mention here, we do have some new desk review requirements that CMS passed on to us, and they are emphasizing a little bit more than they have in the past on cost reviews, even for those PPS hospitals where cost itself doesn't necessarily lead to a reimbursement impact. In some cases, it's data accuracy they're concerned with. They want us to kind of look at certain issues that come up. So that's just one thing I wanted to stress. You might see some of those requests that seem a little odd at first. Some of these requests, whether it be for a critical access hospital or maybe even a PPS hospital, especially if it has large amounts of pass-through cost reimbursement, like GME, I shouldn't say GME, nursing and allied health, organ acquisition, maybe even CRNA, those types of things are impacted by cost. Not as much as a CAW, but still some. So we might be asking for things like explanations of variances in certain cost centers over the prior year. Again, we can't really give percentages, but if you see a particular cost center, if you're aware that it's changed above and beyond what you might consider a normal inflationary increase, then that might very well be something we're going to ask for an explanation on. So you can consider either having some of that ready to go up front or just be aware that we might request it. The issue of grouping of accounts to cost centers, so accounts in your general ledger to the Medicare cost report, that comes up as well. And we're looking mainly for consistency there. If you used to group an account to one cost center and this year you're grouping it to a different cost center, is there a logical reason for it? Not saying it's not allowable, but what's changed? Why is it going somewhere else? CMS definitely has us scrutinizing direct assignment of overhead costs more than they did in the past. Now, again, by the way, when I say these changes, there are some cost reports that have been reviewed under these new UDR requirements already the past few months, but we're starting to move into this new desk review. So within the next year or so, pretty much every provider is going to be reviewed under this new desk review. You might see some new questions. Another thing is just consistency of those groupings. I guess I talked about that up above. No, this is consistency between how something is grouped as an expense versus how the related item is grouped as a revenue. Wherever you group it, it makes sense it should go to the same type of account for revenue and expense. Some reviews of beds and days, and I know some critical access hospitals have already received some of these requests. There was a CMS Form 1539 that they've asked us to start requesting, and it was kind of an odd request because we've been finding out providers don't have that generally. It's not sent to them. So we're working with CMS to try to get that step revised. But in general, if the beds have changed, we might be asking for, if they change dramatically or drastically, we might be asking for documentation or explanations, really. There's more of a focus on home office and related party costs, more of a focus on, well, I guess I'd say the thresholds, the scoping has changed for organ acquisition. So it's likely that if you have organ acquisition, maybe more of the transplant programs you have might be scoped than they have in the past. And provider-based entities, especially those that have not attested under 42 CFR 41365, the provider-based attestation, it's not required to fill out the attestation, but it's still required to meet the underlying requirements. So there are situations, for example, if If you've attested to some of your provider-based entities, but not other provider-based entities, we might be asking, why was there a reason for that? We might be asking for some of the pieces that attestation would have normally required. So potentially more scrutiny on those. And now back to the topic of the actual cost report documentation itself, what I started on a bit ago. Those templates that I mentioned that many of you have been using, the specific template is not required with the exception of bad debt. Bad debt has had a specific template for a number of years, but except for that, really the only requirement is that you have some sort of listing, a claim by claim listing for what you're reporting, and it has to correspond to the amount on the cost report. We have draft templates that we've had out there for a couple of years now. You can find them at this link right here. We also put out a YouTube video explaining the different fields of those templates. And here is the 2018 Federal Register that started this requirement to begin with. It's effective for cost report periods beginning 10/1/18 and after. And, for many of these things, they just only apply to hospitals. GME, DISH, even S10, they only apply to hospitals. But bad debts apply to almost all the provider types. So that would certainly apply there as well. Now, again, the template itself has not been required, but it will be in the very near future. And there was a Federal Register back in June of this year that basically proposed specific templates, specific changes to the cost reporting instructions, specific columns. And this website right here, the cms.gov website, gives you those draft templates. They are a bit different than the draft we've been working off of. It's been a work in progress between Max, CMS, and some other contractors. The public comments are already obviously past due. We've already submitted ours. You may have submitted some as well. These were initially proposed to be effective for fiscal years beginning on or after 10/1/22. Obviously, we're a couple of months past that already. That doesn't mean CMS necessarily has to change this effective date, but the longer we go, the further into the year we get, the more likely that becomes that they will update that date. Again, we're just speculating there, more to come on that. Let's see, where are we time-wise? About 5 minutes before the hour. So I'll go through some of the templates, keeping in mind that we already know some of these items are changing in the last draft we were working with CMS on. So the one that actually comes out whenever it goes through the process will be a little bit different than this. But we'll just walk through some of these. Medicaid DISH eligible days. With really any of these listings, you're going to have a generic section for just patient claim information, name, date of service, some sort of identifying number so that we can look that patient up. We can look up the account. Medicaid in this case, because it's Medicaid day, so they have to have a Medicaid number. Some sort of state eligibility code from that particular state. That's important because part of our audit for DISH is looking at the Medicaid plan and making sure that whatever you're reporting was one of their Title 19 days to begin with, one of their allowable plans. So that's why column 8 is important. We need to know possibly a little bit of information. Is it an L&D day, a newborn baby day? Because obviously those have different requirements to them. Were there any other payers involved? And then how or when were they Medicare eligible? Was it midway through the year or whatever? And then some sort of, if you have comments, you can fill that in. Charity care listing, it's changed a little bit from the listing we've been using. Again, you have the generic patient claim information, insurance status, uninsured or insured. Do you have, or what are the payers if there are any? Obviously, if there are payers and we see this as uninsured, then we might ask the question, what's going on? It seems like there's an insurance company It might be that, yes, there's an insurance company, but they didn't cover that claim. That might be why it's uninsured. So this just leads to various reviews and various questions that come up. The key thing with charity care is that we're starting with total charges for that claim, and we're working our way down to figure out where did those charges go. Some of them were professional, so they were carved out. Some of them are deductibles and coinsurance. Some of them were paid by third parties. There might be a contractual allowance, something that's non-covered, written off as bad debt. Maybe the patient paid a portion of that. We're not talking charity care. They paid a portion that they were still liable for. And then we get to the point where it might be charity care for one reason or another. The very last column here is our column 21, the write-off date, showing what period it should belong in. By the way, when we do get more information about the next draft, we will have updated templates on the website, an updated YouTube video walking through that. So right now, I'm kind of going through this somewhat fast just because, first of all, we've already covered it before, but second of all, it's likely to change in the near future. Total bad debt listing, very similar to the charity care listing up until, well, again, we have total charges and then we back out certain things. The main difference here is that you're going to have charity care that you're backing out as well, but it's not necessarily the exact same amount from that last listing. This is any charity care that has ever been written off of this claim throughout its entire history, whether it was this year, last year, it doesn't matter, because the idea here is we're trying to back down to what is the final bad debt allowable amount. This last listing, on the other hand, this charity care only reflected write-offs from this period. So that's the difference. Medicare bad debt, that's probably the one you're most familiar with, at least the original exhibit, the exhibit 2. Now it used to be exhibit 5. Basically looking for information about the claim. What's the MBI or HIC number? Is it a Medicaid patient? Or perhaps is it deemed indigent for another reason? If it's Medicaid, what was the remittance advice date? What's the patient responsibility amount? And date it was first sent to the beneficiary. That helps us to determine if it was timely billed on or shortly after discharge of the patient. And then we have the write-off date, which we often compare against the date of first bill to make sure you've waited 120 days of collection unless it's indigent or Medicaid. With Medicare bad debts, of course, it's required to be, if it's sent to the collection agency, it's required to be returned from the collection agency before it's eligible for a Medicare write-off. And we have a column here, column 17, which again, the numbering might change. This is the true Medicare write-off date, and the instructions for this particular column basically say this is the latest of these other dates: the accounts receivable write-off, the return from collection agency, the collection effort cease date, and actually also the Medicaid remittance advice date. In other words, you could not write it off for Medicare until all these other things have been met. So whichever one is the latest of those 4 columns becomes the Medicare write-off date. There's a little section for recoveries, and then again, current year payments. So recoveries are amounts that were collected related to prior year bad debts. Current year payments relate to accounts that you were going to write off this year, but now the patient came back and paid it quickly. So there's a little bit of a distinction there. And then finally, we end up with the allowable bad debts. And again, you might have some comments there. So those are the last of our templates that we'll talk about. And it looks like we have some CMS, or I'm sorry, some questions here. One of them is related to those S10 reporting schedules and the instruction changes, when do we expect to hear guidance from CMS to finalize those changes, since they might go into effect for the 9/30/23 cost report? The answer really is that actually already expected to see them by now. We had some discussions with CMS on the various things, and I know it's going through the process. I've heard a little bit of an update, but we really don't know for sure. I mean, I could say, a month from now, but who knows? It might be 2 months or 3 months. But you do make a good point about the S10 side of things. Now, the one thing I wanted to mention, that effective date said 10/1/22, and as I mentioned, the further we go through that year, the more likely it is that CMS will decide to bump it. However, all of those items are still things that you would have still needed them in your system. So it's not like you're having to track different things. It's just that now you're going to have to pull it out and report it. Because we could have asked for any of those items through an S10 audit, regardless of whether it was in the listing or not. But you still make a good point. It makes a lot more sense for providers to be aware of the specific listing requirements well in advance, before the year gets underway or gets too far underway. So I hope soon, but I really don't have a definite answer on that. And let's see, we are just a little bit after the hour, so we're going to continue on to make sure we can cover everything here. Dish, I wanted to bring up again, really fairly quickly, not a whole lot of new information. We've certainly been waiting for updates on this, the news on it. But there have been a lot of pending issues with Dish for quite a few years now. And I'm really going to focus on two aspects of it. Treatment of Part C or Medicare Advantage days. That was covered in various ALINA court decisions, most notably the one from 2019. And we have CR 10487, change request 10487, that covered that. And it talked about, but basically these are on hold. I shouldn't say on hold. We have notices of reopening out for these because we were waiting to see how does CMS want to treat this. But keep in mind with Part C, the question is, since that patient is no longer covered by Medicare Part A, should they be in the Medicare Part A SSI ratio, or should they be in Medicaid ratio, assuming, of course, they qualified for Medicaid? The other issue is total versus covered days. In other words, exhausted benefits. They're still Medicare Part A beneficiaries, but for one reason or another, they've exhausted their benefits. With Part C, arguably, they've given up Medicare Part A benefits to get Part C instead. With exhausted benefits, they just ran out of Part A benefits altogether. But the underlying issue that's been coming out of especially the absolute most recent Supreme Court decision is that regardless of whether they're paid or covered by Part A anymore, they're still Medicare Part A entitled, which is the word used in the statute and basically the statute. That's as far back as I'll go there. So that Empire Supreme Court decision that was decided just a few months ago in June of this year basically said that the patients entitled to Medicare Part A are still entitled to the program, regardless of whether they really get paid for it or get any benefits from it. So that's kind of where we are there. The Ninth Circuit initially sided with the providers on that, and basically they said that particular 2004 regulation that made this determination about entitlement was not done in a valid way. It wasn't done through the normal notice and rulemaking process, and because of that, they would belong in the Medicaid ratio instead of the Medicare SSI ratio. Ultimately, the Supreme Court in this decision up here agreed with CMS, or Health and Human Services, but the Ninth Circuit initially sided with the providers, and because of that, CMS, right after that Ninth Circuit court decision was issued, they had to go back and change the 2019 and 20 SSI ratios to exclude, or I'm sorry, they didn't change it. When they issued the 2019 and 20 SSI ratios, they had to follow the rule just for those Ninth Circuit providers. They had to follow the rule applied by that court. So those initially published SSI ratios excluded those exhausted benefit days out of the SSI ratio because they were instead going to be included in the Medicaid ratio. But recently, after the Supreme Court decision was issued, CMS went to the website and they updated the 2019 and 20 SSI ratios for just these Ninth Circuit Court states, if you will, to re-include the exhausted benefit days. All the other years and all the other districts already had exhausted benefit days included. And so, in other words, based on the current Supreme Court decision, the SSI ratios are now correct as one could get them to be at this point, following this rule, I'll say. However, we're still waiting on a response to CMS's initial proposed rule related to the Alina court decision on the Part C days. Now, here's the point I want to try to make here, though. I'm trying to draw a similarity or a connection between the Alina issue and the exhausted benefit, the Empire issue. They're really the same underlying issue, just two different ways of losing coverage, if you will, or giving up coverage, but it still boils down to that entitlement. So there was a proposed rule that CMS issued back in 2020 that basically said, hey, they're going to retroactively create a regulation that says they're going to include those Part C days in the Medicare SSI ratio. They tried to fix the rulemaking issue that way, and they gave an argument for it. We haven't seen that finalized. My expectation was after that Empire Supreme Court decision, maybe it would have been finalized. We really honestly do not hear anything on this issue. We've been asking for updates. At some point, CMS will make a decision, but until they do, we really can't do anything with it. We can't move on these. So that's kind of where we are at this point. We're waiting for a CMS response, and we're waiting to find out, what does that mean for those Alina hospitals that we had notice of reopenings out there for? What does that mean for any SSI realignment request that's pending? Basically, all of those issues. It's kind of on hold there. So a little bit of information, at least a little bit of background, but really don't have any final word. So hopefully soon. And let's see here. I see a couple questions. So the 3A and 3B requirements relate to pulling remit level data such as non-covered charges. That was not included in what we typically load into the data warehouse. So the non-covered charges. So as a result, you have to pull this information from the 835 files or through another manner. So I guess the one thing I'll mention, though, is like the non-covered charges, you'd still, even today, even the past few years, you'd still have to somehow get that data to make sure you're putting it in the proper column. So one way or the other, you have to have a way right now to get it. Otherwise, you're going to be putting it in the wrong column. You might be putting it as insured when it really belonged as uninsured. So I guess that was the point I'm trying to make. The rules for the cost reporting haven't changed. The data still needs to go in the right place. So we're just wanting to see the listing of how you put it in the right place. And for the Medicare Part B eligible only days, that's a good question. I'm not sure if they would actually, if they're Part B eligible only. Oh yeah, okay. I see where you're getting at now. You're correct. If they're not entitled to Medicare Part A for whatever reason, they haven't met the requirements, the work requirements to be Medicare Part A entitled, then you're exactly right. They would only be in the Medicaid fraction, assuming, of course, that they were Medicaid eligible to begin with. Yep, you're exactly right there. And for the SSI ratios for 2021, no word on that one. Let me check something here. Let me look at the CMS website. I'll kind of show you where those are found and kind of how to translate that, how to read through that here. Let me pull that up just 1 second. So I have that pulled up. In fact, let me walk back through that. The CMS.gov website, and they're always found under acute inpatient PPS. So if you go to this Medicare section, acute inpatient PPS, and then they're under the dish section over here. And they have a big old list of SSI ratios. There were some of these older ratios related to that 1498 ruling, but if you scroll down a little bit more, you'll see the current ratios. And right now, the 2020 is the latest. In fact, here's another point I want to make. If you were to open this up and you'll actually get the zip file, but then what you'll see in the zip file, you'll be able to tell the date those were updated. So this is what I was mentioning earlier, how CMS updated those dates after that ruling was made. So these were updated 9/29, and if you look at the 2019s, it would be the same thing. But yeah, we don't actually have any word to answer your question more directly. We don't have any word on the 2021s at this point. So, and part of it might be just the data gathering. Part of it might be some of these rule changes or trying to fix everything. So good questions there. The next topic I have here is a new one. We haven't covered this yet. It's pretty new as far as the implementation of it. There was a court case for the Milton S. Hershey Medical Center, and the decision came out actually in May of 2021. The decision was out of the D.C. District Court. Now, that's not the Circuit Court of Appeals, so it doesn't have precedential value for the entire country. It's just for that case under review. But there was an issue with how fellows are being trained and how they're being counted more specifically. A fellow, of course, is essentially a resident that's beyond the initial residency period. They become a fellow after they end that initial residency period. And the reason that's important is that for cost reporting purposes, for reimbursement purposes of GME, a fellow is counted at 50% of a normal resident. Because they've stayed so long, they're past what CMS essentially agreed to pay for. They only get weighted at half, 50%. The problem is the way the math was working in the regulation and, of course, the cost reporting instructions. If a provider had these fellows and they exceeded the cap overall, there was basically a kind of a penalty, just the way the math worked out, where they actually have a lower FTE allowable amount than if they didn't have fellows at all, even though in both scenarios they were subject to the cap. And we'll cover that in just a couple examples here. But the point is, in this decision, it was found that the regulation was contrary to statute. And here's the regulation itself. So here are a couple of examples. And actually, the second one we'll go through is a little bit cleaner to see. But the first one says, let's assume they have a cap of 100. In scenario one, let's assume they're below the cap. So the hospital employs 90 residents and 10 fellows, but those 10 fellows are weighted at 0.5. So essentially it's going to be, you have 100 people, so to speak, let's say that, but 10 of them are weighted at 0.5. So if you do the math there, you'd end up being at 95 for that particular scenario. They were below the cap of 100. They were allowed 95. So let's say they add 10 more fellows. Now they're exceeding the cap of 100 because they have 90 residents and 20 fellows. Even though those 20 are weighted at 0.5, there's still 110 people there, so to speak. But the thing is, yes, they've exceeded the cap of 100, but one would expect that at a minimum, hey, they'd at least get these 95. But if you do the math, you end up with 90.91, and there's really no reason their allowable count should have decreased. If you have more people, you would never expect the allowable count to decrease. At a minimum, it would stay right where it was. And that was the argument from that Hershey decision. Here's a better example, a kind of a cleaner example. Again, the same 100 cap. You still have 150 residents in both of these hospitals within the initial residency period. But with Hospital A, you have 0 fellows. Hospital B, you have 50 fellows. The unweighted FTEs are going to be 150 and 200. Again, when I said people, that's basically unweighted FTEs. Now, the weighted FTEs under the current calculations, it would be 150. There's no weighting. There's no fellows here, so there's no reason to weight them. 150 times 100 divided by 150 to apply their cap, they would get exactly 100 because, of course, that was their cap. They can't possibly get more than that. With Hospital B, yes, they added fellows, but they kept the same amount of residents in the initial residency period. So again, you wouldn't expect it to go below 100. They have more people, unweighted FTEs. They have 200 now. But if you do the math, the weighted FTEs would be 175, still more than 150. But again, if you apply the mathematical calculation from the regulation, hey, you end up at 87.5. So they were penalized mathematically just for having additional fellows. And that was the argument within the case, that this just does not make mathematical or logical sense. It's contrary to the statute. So even though it was just a district court decision, wasn't a circuit court of appeals, CMS decided not to challenge that. They implemented that through the federal fiscal year 2023 rule, and that was 8/10 of 2022. They implemented that decision. They revised the regulation. Now, as soon as they decided they were going to implement this, we were instructed point after that final rule was issued. Now, finally, though, HFS has made the necessary cost reporting instructions for us to be able to release these cost reports with the proper calculation, which we're going to go to in just a bit in a couple slides. And I have some additional things to point out about that. Now, here's the news that we needed to mention to make sure this is clear. Of course, those providers that were part of the appeal and they won the appeal, they're going to be revised. They have to be revised. And any future cost report from this point on, including those that were held, will be settled with the new calculation. The problem, though, is with reopenings, even though there's a change in the regulation now, this does not apply to reopenings. In fact, if you look at the regulation, 42 CFR 405, precedent or otherwise, is not a basis for reopening. In other words, we can't just go back and say, well, hey, let's take a look at any provider that at any point in time, or even within 3 years, might have been calculated under the old rule. We can't go back and decide to reopen those. It's regulatorily barred. Again, the appeal, we're forced to. They won the appeal. The only way out of that is to settle that, revise the settlement. It's not even called a reopening at that point. It's called a revised settlement. And of course, any future cost report is going to come through with that settlement change, but retroactively it won't be. So what I want to point out here, again, any current cost report that has not yet been settled will be reported under the new proper calculation, if you will. So this is going to impact a few different things. E-4 line 9, which is your current year weighted FTE count. And of course, line 12 and 13, they report the prior year and penultimate FTE counts. which obviously we'd pull from a previous cost report, but we'd have to recalculate it under the new rules to bring it forward. And then, we already talked about the calculation a bit ago. They've just essentially split it out to handle it properly to avoid that, what they called proportional reduction. That was the term for it. So here's the tricky part, though. And this kind of goes to one of the questions that was brought up. HFS at this point, they made an update that's kind of an informal update because we're still waiting on CMS to make the transmittal change that formally updates it for everybody. But HFS made some changes that allow us to settle the cost reports with the proper calculation. But since it's not formal, a provider would not be able to go in there and actually make changes to that line. It's a MAC only line at this point. So we can settle it with the proper amount. It's done through kind of a workaround. In fact, the specific workaround is on E-4, line 109. It's a brand new line. Column 0 is just a control question that triggers this. Column 1 and 2 are the revised FTE counts for primary care or other. So that's how we're able to settle those that were on hold. And for that matter, even if we just wrapped up a desk review today, we could settle it by doing this. Now, the only trick to this, not really a trick, but the kind of a problem is there's a printing issue right now with that line. So even if we were to print this and send it to you in PDF, it still looks like it's blank. And that's an issue HFS said they'll correct, but the calculations are going through properly. In fact, we have work papers that we have as kind of support that will show you. In fact, what they do basically is they recalculate it for the prior year and penultimate. Since the cost report wasn't done that way initially, we recalculated under the new rules. So we have the work paper that we'll send with those. And again, we're expecting a change in, hopefully in transmittal 18, maybe even a little bit before for the formal change. Here's just a quick illustration of what it looks like. But again, it's Mac only, so you can't go in here and update these. So that actually addresses the question here, should providers amend any open cost report? The answer would be certainly right now you won't be able to. It won't let you do anything. Now, going forward, whether CMS wants providers to amend it or whether they just want to let us handle it through settlement, that'll have to come out when they issue the instructions. I'm not sure which approach they'll want to take. I imagine after they make the change, I imagine it would give you the ability to amend if you wanted to, but you certainly wouldn't have to. We'd catch it at final settlement. Yeah, Brian, so that's a good question. We won't actually go into the old cost report. For example, we can't reopen the prior and penultimate, so we won't resettle those cost reports, but we're recalculating it based on the rule. So we're recalculating the prior and penultimate FTEs based on the new regulation. In other words, as I mentioned in this slide, it's an off cost report calculation, and that's where those work papers will come into play. Unless CMS comes up with some very unique way of handling it through HFS, I don't know if they will. I doubt it. So it's probably still going to remain an off-cost report calculation. Kathy, so the time frame that matters is when did CMS issue that final rule? So it wasn't so much the decision, because the decision arguably only was precedent. It wasn't really even precedent. It only impacted the appellants, the providers that were part of that appeal. It really didn't have any precedent for anybody else. But CMS decided, since they weren't going to challenge it, they just decided it would be better for them to change the regulation to avoid future appeals. But so what I'm saying here, the case was this final rule. So a good question there. And for material to the provider's reimbursement. So I don't know if you're talking about a threshold. For our reopening threshold, which again is not really related to this anyways, but the standard reopening threshold is $10,000 of materiality. But however, uh, if it's part of the appeal, we have to revise the settlement regardless of materiality. The other point I wanted to make, though, with this, let me get to that in a second here. Maybe let me think about what I'm missing here. Oh yeah. So what does this mean for providers? The only way, or let me say it this way. Obviously, if you don't have GME, it certainly doesn't apply to you. But also, if you don't train fellows, if you have no residents beyond that initial residency period, then this is a moot point. It didn't impact you. And of course, if you don't have a cap established at all, if you're a new teaching hospital, then it's irrelevant as well. So that's just one thing to keep in mind, that it doesn't impact every hospital. But for those that do have those interns out, or no, residents outside of the residency period, that's where the calculation would be different. And Tom, so if you reopen for another issue, we would only be able to revise that other issue. Basically, we cannot revise this GME calculation. Whenever we get a reopening request, we have to look at each piece of it to see if each piece is allowable for reopening. There might be a situation where you try to reopen, let's say, 4 issues. We might be accepting 2 or 3 and denying the other 1 or 2. That happens quite frequently. It just depends on, is it allowable, first of all? Do you have the documentation? All of that. So probably the reason it gave you the level 1 edit is, I'm surprised it gave you that verbiage, but yeah, I'm surprised it even allowed you to, honestly. But I think the level 1 edit is probably because you're not allowed to update that at this point. We can from our side. And yeah, Natalie, that's a great idea. Put it as a protested amount, since obviously you're protesting the current treatment of that. That makes sense. But again, at final settlement, for those that have not been settled yet, we would be handling it as well. So very good questions there. A lot of good topics. So that was a brand new one we hadn't covered before. And again, hopefully we have more in the near future on that once CMS issues the instructions, and hopefully they're clear enough to uh, talk about exactly what they're going to do. The other thing to mention, though, is it's most likely when CMS does update the instructions, they probably won't be doing it on E-4. They'll most likely be doing it on S-2 as a control question, and then these lines will probably become irrelevant. So down the road later on, if we ever do another reopening for any other issue after we've settled it with this change, we'll most likely have to fix that S2 question to put it in the proper place, because these will probably be gone. Again, I'm speculating. Maybe CMS will have a way to work around that, but they'll probably have us do a cleanup after these informal cells are gone. So let's see here. Moving on to the next topic, we have basically a listing of our website, webinars, YouTube channel information. And the first link I have here is to just our website in general. In fact, I'm going to go ahead and open that up to walk through a few things. So that particular link takes us directly to the cost report audit. But if you just type in WPSGHA.com, you're going to get something more like this. And of course, we have a search bar here. So if the term you're putting in is not too generic, it might take you right to the article. But if you want to browse to Medicare audit from this main page, it's just the cost report audit section. Of course, you have claims. These are claims appeals, not cost report appeals. Fee schedules, provider enrollment, but of course, cost report audit is what we're looking for. And we have here a few different things. And by the way, I do want to go back here one more time. At the top of our main web page, we have what's called the carousel. We have a handful, I think just 5 topics on a variety of issues that come up. One of the most recent ones for audit was the low volume. This is a place we put really more urgent type things or really quick hits on certain things. So we'll put them up there, and they usually link to a full-blown article. Once you get down to cost report audit, you have a few things. We have some of the articles that are at the top. They're called featured guides and resources. But then you could also search for, or just browse, I guess, for the topics you're looking for. For example, low volume add-on payment. Here we have the 2023 extension. If we go down to S10 uncompensated care, we have a couple of articles there. Bad debt, you have a lot of fairly new articles based on the regulation. We broke things out quite a bit here. And then one of the fairly new ones was sole community Medicare dependent hospital volume decrease adjustment. In any case, you'll see those articles. And the one I wanted to point you to is under the training section. And that's the WPS Medicare Audit YouTube and training. So the idea here was we wanted to have a collection of our YouTube videos. The very first link, though, is to the YouTube playlist itself. So I'll open this up, and it's the YouTube playlist. And it takes you straight to the audit section. You know, we just started this back in, I think 2019 was our very first one. And we have about 24 audit-related topics. And I have, as we'll see in just a bit, I have a few more that I'm going to be putting through either this last couple of weeks of the year. Some of them might even span into the beginning of next year. Some of the most recent ones, or the two most recent ones, were home office costs and allocation and sole community hospital Medicare dependent hospital qualifications. I put information on those two here. But we have, again, the listing. And the goal is just to provide training, provide quick hits in some cases on various topics that come up. We refresh that from time to time and try to see if there are any pieces of information that providers would like to see that we don't have out there already. So that's the overall goal. And the next thing I wanted to talk about here was home office documentation. So I wanted to spend a little bit of time with this. So with home office documentation, this is something, again, a lot of this comes from that YouTube video that we just posted. There were a few things I wanted to talk about a little bit in more detail, though. So here's that Federal Register, that same Federal Register from earlier, where we said that if you have a home office, you need to make sure the home office cost statement has been filed with your servicing MAC. The definition, well, not the definition, what determines whether or not a home office cost statement is required is whether or not that's a chain organization consisting of a group of two or more healthcare facilities, which are owned, basically they're related to the provider, or they're related to one, they're controlled by one organization. Now, the chain organization can also have non-providers, and quite a few often do, or they're non-hospitals, for example. So that's just a definition there. So if you do need to establish a new home office based on these requirements, maybe you have not filled out a formal home office cost statement and now you need to, we have one of our articles that walks through that. It kind of defines that. It references the Federal Register again. And if you do have one you need to submit, there's a new home office questionnaire linked inside of that article. And you can send it either to me via email at audit.advisement@wpsic.com, or you can send it via mail to this address right here. And here is the questionnaire. It's pretty basic, but we just need to identify, who are the contacts for that home office. What's the name? Are you really a home office? Do you meet this definition? What types of services do you provide to the chain, or do you provide to the providers? What type of services does the chain provide to the providers? What's the organizational structure, the effective date, and are there any other home offices related to this? So that kind of talks about regional offices in some cases. There might be multiple home offices providing services to a provider, and we need to know about that as well, because each of them may very well need to file their own home office cost statement. So, I mentioned in the UDR section that there's a little bit more discussion on home offices and related party costs in the new UDR, the new desk review. And in fact, they split them. They have us focus on each independently because, yes, home offices are related parties, but there might be other related parties as well that are providing services. And they have specific things we're going to be looking at. We often refer to the non-home office as just an other related party. The key thing here, if you have cost that's being allocated from one main entity to multiple providers or other entities, in other words, two or more entities of some sort, including, of course, at least one provider, that's where we need to see the documentation. If it's a cost that's directly incurred by the provider, in other words, they're billed for it and they pay for it, then we need to see that documentation for the invoice and payment. But if it's an allocated cost, then first of all, we need to see documentation that the home office themselves incurred that cost, and then we need to see how it was allocated to the various entities. Was it allocated via functional statistics or just some sort of general pooled statistic like total costs or total days? We need to see that documentation, though. So, of course, the underlying principle of Section 1000 of 15.1 is basically that any cost that the provider is allocated or incurs from a related party is at most allowed at the cost to the related organization themselves. In other words, they can't pass through a markup, they can't pass through profit to the provider. It's only cost that's allowable. So they're, by their nature, they're subject to a pretty specific review. So we need to see that these costs exist. They need to be transparent. There are a variety of sections in the cost report that help with this. Worksheet S-2, both part 1 and 2, have 3 separate questions relating to this. Line 140 asks, are there any related organization or home office costs? That's the first column, yes or no. If it's indeed a home office, we need to see the number. And again, we would expect a home office cost statement to the servicing MAC. And then for that reason, we need to see who is that MAC. Line 3 of S-2 part 2 just said, are there any related party costs at all? Line 36, are there any home office costs specifically? So if we can tell that there are some related party costs, we know we need to review those. Anytime you have related party costs for any reason, worksheet A81 needs to be filled out. A81 is basically to document how much of those costs are truly allowable for this provider. But we have a couple of situations that could happen here. Your classic example is, for example, you reported $15,000 on a particular cost center of worksheet A, but the underlying cost to the related party was only $10,000. So A81 would be needed to adjust out that excess $5,000 of profit or markup or whatever. But you could also have an example too, where maybe you did not directly incur any costs from that transaction, so there's nothing at all on worksheet A for that related party transaction. However, $10,000 is being allocated to you by the home office or related party, and it's documented on A81. In that situation, the purpose of A81 would be to adjust in that extra $10,000 that you're allowed to report, but you just hadn't reported it yet because you didn't incur it. So kind of going back up to example 1, it says the provider reported $15,000. That's most likely because they incurred that cost. They were billed for it, they paid for it, but regardless of what you paid, if the related party only cost them $10,000, that's all you're allowed. So now what we have here is just a generic, just a kind of a dummy version of worksheet A81 I filled out to kind of show how this works. It's a little tricky sometimes with the labels and the instructions, and in my mind, it's a little backwards with how they've ordered it. But what we have here is column 5. We take a look at all these different lines, all these different expense items, these categories, so to speak. This shows that, hey, line on this column 5, this amount is what was already reported on this cost center of worksheet A. Now, keep in mind, though, if you look down here at line 3 and 3.01, both of these items related to cost center 5, A and G. So there are two different related party transactions related to line 5. No problem. So what we're seeing in this column is just how much is reported on line 5 for only this one transaction. For this home office other, apparently there was nothing reported yet. But for this second related party transaction, there was $203,800 or $785 reported. So let's jump over to worksheet A really quick. Here we have line 5, and in total, there are, well, actually, I should look at this line right here, column 5. So in total, there was $9.9 million reported in line 5. But if we go back, only $203,000 of that amount related to really any related party transaction. So that's what we're saying. Hey, we've already reported $203,000 for this transaction, but guess what? The underlying cost, this column 4 amount, was only $200,456. So for that example, we have to subtract out some of the cost. But for this other example, this home office other, the provider didn't report anything yet because they didn't incur the cost. But after looking at the home office, maybe $10 million is allowable. Again, that would be subject to separate review, but that's just how this particular mechanism works. Column 5 is what was already reported as part of a bunch of other things on these cost centers. Column 4 is how much ultimately should be allowed, more or less than what was already reported. Let's see. So the trick here, we've proposed some changes to CMS for the design of worksheet A81 to make it clearer to all parties. In that example I said earlier, we had some labels here, and we could see that there were two different things going on with line 5. But the problem is there might be multiple related parties involved with this situation. This was pretty clear. It said home office, and then it said, well, here it had merged, miscellaneous related party and home office. So there might actually be two or more parties related to this. So as far as the documentation, for this $200,456, there might be multiple things we need to look at to get that amount. What we've proposed to CMS is that every line here should only relate to one related party. And we should be able to tell, was it a home office or was it somebody else? So that for that documentation, there should be one nice, pretty clean piece of documentation to support this amount. Again, we've proposed it. Right now, there's a part B to this that just lists out what related parties do you have, but there's absolutely no linkage between this section and that other section. So we have no way of knowing just by looking at this which related party relates to each of these transactions. And that's where the problem comes in. Let's see. The other thing here, we have to make sure that any related party cost ultimately has to relate to a specific service provided to the hospital. You can't just pass down costs for no reason. There have to be services that you can use to support it. Home offices, the cost statement, you can have a direct assignment, a functional allocation using a statistic, or as a last resort, a pool allocation. If there's no better way to assign or allocate that cost, It can be done through pooled allocation. These are schedules E, F, and G on the home office cost statement. But something that came up from CMS through appeals a few years back was when you have an other related party cost that's not a home office, these can only be directly assigned or functionally allocated. You can't have pooled allocation without any sort of support for an other related party cost. So the key thing about pooled allocation, we're talking about a very generic statistic like total days or total cost, something that really doesn't have a strong correlation with the ultimate usage of that service. It's just a last resort way to allocate costs out. But CMS's response was that this pooled allocation is only allowable if we're dealing with a true home office cost statement. So that's one thing that we wanted to stress in our video and our website. The other thing I wanted to bring up, a topic that's come up from time to time, is that if you have multiple levels of home offices, in your classic example, you have a main home office that itself might provide services to multiple hospitals, but then you have regional offices underneath of it that provide other services, maybe even the majority of services, to just hospitals within their region. So the thing is, and I have an illustration in a bit, both of those entities, both of those levels might be passing costs down to respective providers, but we want to make sure if you do have a regional office, the home office cost might be allocated down to the regional office first, and then on the regional office home office cost statement, you're going to allocate to your own providers. But the point here is that consolidating data on one line, in other words, treating that regional home office as just a regular healthcare entity, that's not allowable. In fact, if you go to, for example, Schedule E of the home office cost statement, there's a separate section for regional offices altogether for this very reason. If we see a regional office, we know to expect yet another quote unquote home office cost statement to allocate all of these costs from the regional office further down to their own components. So here's a very basic illustration. Ultimately, we're concerned about what is allocated to the healthcare components, the providers. Some of those costs come directly from the home office. Some of them come from the regional offices that had their own incurred costs, as well as getting some from the home office themselves. And the last item related to home office is acute care hospitals that are allocating costs to a critical access hospital. This was addressed in that Federal Register that we referenced a bit ago. And the idea here is if you have a lot of times there might be a critical access hospital that that's a related party to an acute care hospital. The acute is almost acting like a home office to that critical access hospital. They can act the acute care hospital can allocate costs to the CAW, but again, there has to be documentation regarding the services provided and what those costs were. One of the ways this is done, this has been done at least, is that the acute has, instead of filing its own home office cost statement, it sets the critical access hospital up as a non-reimbursable cost center, and then it steps costs down to that critical access, that non-reimbursable cost center. And then at that point, whatever's left in that non-reimbursable cost center is then brought over to the critical access hospital. And this is fine. CMS said that's fine, but they cannot bring over all the costs from the critical access itself as your starting point on worksheet A of the acute care hospital, that non-reimbursable cost center on the acute care hospital. Instead, it's going to start with zero cost, and then it's just going to get overhead step down to it if you have a statistic. So if you can directly identify how much cost relates to a service provided by the acute to the CAW, then you can reclass it down to that non-reimbursable cost center. Or if you have some sort of statistic that documents how much of that service belongs to the CAW, you could functionally allocate it through a B-1 statistic. But because of this, the only way you're going to get any A&G overhead cost, which is, it's the third cost center over, well, the third group of cost centers at least, the only way you'll get that down to the CAW, the non-reimbursable cost center related to the CAW, is if you had some sort of capital costs that were stepped down or reclassed from the acute care down to this CAW cost center, or if you had employee benefits, because then these would generate an accumulated cost that is then used to allocate A&G. So that's the point CMS wanted to make. You can't get A&G based on every dollar of cost the CAW has from its own cost center. That has no basis on how much A&G that critical access hospital should get. So that's the point I wanted to make there, and that's the last one for the home office. I know we're down to a few minutes. The good news is we're down to just a few slides here. The last one, we talked about the website and the webinars and the YouTube channel. These next few slides are basically just a list of all of the YouTube videos we've put out there so far. And we kind of walked through that a bit ago anyways. Notice, well, somehow my slides got out of whack. Notice, though, that the last couple I talked about were the SCH MDH and the home office. And my webinar slide, oh, you know what? Yeah, that's not even supposed to be in there. There's one, here's the new webinar slide, talking about what webinars we've had in the past. Obviously today, we have one planned tentatively for about February of 2023, and it'll be specific to S10 at that point because we'll be right in the beginning of that. And then the last kind of thing I wanted to mention before I look at the questions again is that we have additional YouTube updates or YouTube videos planned for the near future. Setting and base years is really kind of the same thing, and the payment mechanism itself for the hospital-specific payment. And then I also have one I want to put out on the swing bed rates, the nursing facility rates, really what the regulation and policy says, how we calculate them using state data behind the scenes, and of course where to find them on our website. So I wanted to put a video out. We have an article that goes through it, but I've never really put a video out about it. So I'll be discussing that in the next one as well. And that's the last slide I had. So let me go ahead and take a look at the questions again. Back to Brian, would we reopen for a 3-year reopening period if it was appealed in the proper cost reporting year? In other words, before the appeal goes to the PRRB, would we reopen for this issue since it was protested? Now, if you're talking about that GME issue, I think that's when that question may have come up. If it's related to that GME issue, protesting it itself would not have been enough. It would have had to have gone through the full-blown appeal within the normal 180 days for the appeal. But if you're talking in general, if you're talking about any other issue, it really depends on what the issue is. If it's something that we agree with, if it's more like a documentation issue and we just needed that additional documentation, for example, Medicaid days, if it's something like that, we could certainly reopen it or at least consider reopening it instead of that going to appeal. But if it's something that is more contentious, for example, CMS just still doesn't agree with that treatment of it, then of course it would still have to go to appeal. We can't do anything outside of what CMS tells us as far as the policy. So an issue like that would still have to go to appeal. But again, if it was the GME issue, unfortunately, our hands are tied on that one. But if it's not settled at all yet, and it's still open right now, of course, it's going to be handled under the new provisions anyways. And let's see. Oh, Sam, yeah, thanks. I'm glad you liked that YouTube page. That was something we started in 2019, and I think it's been a great idea. It allows us just one more medium to communicate some issues. And Sally, as far as the webinar. Yeah, this one will be on the YouTube page as well. And within about a week, I have to download the recording, and I usually edit it a little bit. I guess there probably aren't too many silent spots this time. I've been talking pretty much nonstop, but I try to clean it up a bit. So I'll let everybody know when that's out there. And the extensions regarding the stem cells. So that's a good point. We have those, the hematopoietic stem cell that CMS really hasn't updated the cost report form set for yet. So as far as the extensions, that's really all we know out there is that anything that is there's no place to put them basically. There's no place to report it and get an actual pass-through payment right now or get updated interim rates. So we don't know. We've asked the question, but we don't know where it is. We have no way of actually updating. There's nothing to update. There's no way to give interim payments at this point. But as far as the extensions, they are kind of on hold right now, so you do not have to submit. And maybe that's what you're getting at. You're saying, yeah, the cost report will not be due until 30 days after CMS issues the form set and it's updated. So you're exactly right. That's where it stands right now. We don't know when it's going to be updated, though. So that's kind of the problem there. And let's see, Conrad. So for the EHR availability rules, ER availability. Oh, I'm sorry about that. Uh, Nothing new on that at this point. Are you talking about how they're trying to merge availability and the on-call kind of under the same policy instead of the two distinct issues they have right now? Is that what you're referring to? And I guess regardless, just any updates. No, unfortunately, we don't, and that's actually been a few years since they mentioned that they were going to be working on that. So it is kind of surprising. It's something we'll bring up with them again. It would definitely be nice to have that stuff clarified. I know there were some appeals on availability itself, the different requirements, who's eligible for availability versus on call. So it'll definitely be nice, but unfortunately at this point we don't really have anything. So looks like we are right at 3 o'clock on the dot. But if there are any questions, I still be glad to take a look at those. Otherwise, this again has been recorded. I'll put this out as soon as it's ready to go. And I thank you very much for your time. I hope everybody has a great week and also have a Merry Christmas and Happy New Year. I'll talk to you next year, if not before.